All right, let's do this. Welcome to your ultimate exam cram for group life insurance. We're going to move fast and hit every single key point you need to absolutely ace this section of your test.
Okay, let's jump right in with a huge one. You are almost guaranteed to see a question on your exam about contributory versus non-contributory plans. And getting it right really just comes down to knowing two, let's call them magic numbers. Do you know them? Well, stick around because we're about to lock them into your memory for good.
So here's our game plan to make sure you master this stuff. First, we'll nail down the basics. Then we'll get into the nitty-gritty of how the plans actually work. After that, we'll cover the specific rules for employees. Section 4 is a big one. We'll put group and individual plans head-to-head. And finally, we'll wrap up with taxes and conversion rules. You know, the details that often trip people up on the exam.
Okay, first up, Section 1, the basics. Let's lay a solid foundation here. Seriously, if you get these core concepts down, all the other details are going to click right into place. So what exactly is group life insurance? Well, at its core, it's pretty simple. It's one single insurance policy that covers a whole bunch of people. But here's the detail your exam is going to care about. What type of policy is it? It's typically an annual renewable term policy. You'll want to remember that.
Now this concept right here, adverse selection, this is the why behind so many of the rules you're about to learn. See, insurers are terrified of a situation where only the sickest people sign up for coverage. So this one idea explains pretty much all the participation rules we're going to talk about.
Okay, on to Section 2. That whole idea of avoiding adverse selection, it directly shapes how these plans are put together. So let's dig into the mechanics of how they actually work, because you can bet these details are prime material for exam questions.
You're going to want to pay close attention to this slide. It's a huge concept. Who owns what? The employer owns the actual policy. They're the ones who get the single master contract. So what about the employee? Well, they don't get a policy. They get a certificate of insurance, which is basically just proof that they're covered. You absolutely have to know that distinction.
And here we are. This is one of the most heavily tested concepts. The difference couldn't be simpler. It all comes down to one question. Who pays? In a contributory plan, the employee contributes. They help pay the premium. In a non-contributory plan, the employer pays for the whole shebang.
And here it is, our first magic number. For a contributory plan, that's the one where employees have to chip in, the insurer needs a way to protect against, you guessed it, adverse selection. That protection is a number, 75%. At least 75% of all the eligible employees have to sign up. You've got to commit that number to memory.
And the second magic number? Well, for a non-contributory plan, since the employer is footing the entire bill, the insurer says, okay, fine, but then 100% of eligible employees have to be covered. No one gets to opt out. So it's 75% for contributory, 100% for non-contributory. Got it? Good.
All right, let's keep moving. Section 3, rules for employees. Now we're going to look at this whole thing from their point of view. You know, who can even get coverage in the first place? When can they sign up? And how was the benefit amount figured out? The exams love to ask about eligibility rules. Just remember these three things. You have to be a full-time employee who is actively at work. There's usually a short waiting period, called a probationary period. And here's the most important part. You get a 31-day window to enroll. Now, why is that window so critical? Because during that time, you can get coverage without proving you're healthy. If you miss it, you might have to go through medical underwriting, which is a whole different ballgame.
So, how is the death benefit amount actually determined? Insurers can't just let people pick their own amounts, right? I mean, think about it. That would bring back our old friend, adverse selection. So instead, they use a formula. It's either based on a multiple of your salary, your job title, or it's just a simple flat amount for everybody. Just be ready to recognize these three methods.
Time for Section 4, where we put group plans and individual plans side by side. You're going to want to really focus here, because this next slide is basically a cheat sheet for a huge chunk of your exam. You know, I'd seriously recommend hitting pause right here and just burning this table into your brain. Let's walk through it real quick. Group plans, one master policy. Individual, everyone gets their own. Underwriting, group plans mean no health check during open enrollment. Individual plans, you have to prove you're insurable. Cost, group is way cheaper. And finally, what happens when you leave your job? Group coverage usually stops. An individual policy? It's yours as long as you pay for it. Every single line on this chart is a potential exam question.
All right, let's bring it home with our final section, number 5, taxes and conversion.
This is the fine print. This is the stuff that shows up as those tricky, detail-oriented questions that can make or break your score. We're going to cover taxes and exactly what happens when you leave the company.
Okay, this right here, the conversion privilege, it's a huge deal. It means if you leave your job, you have the right to convert your group term insurance into an individual whole life policy. And get this is the best part. You don't have to prove you're insurable. It's a guaranteed safety net.
And here is another one of those numbers you just have to know for your exam. How long do you have to use that conversion rate? Exactly 31 days. Not 30, not about a month, 31 days. That is a classic test question.
The tax rules are actually pretty easy to remember. If the employer pays the premium, it's a business expense for them, so it's deductible. If you, the employee, pay it, sorry, no deduction for you. But here's the most important rule of all. The death benefit, when it's paid out as a lump sum, is received by your beneficiary completely 100% tax-free.
Before we finish up, let's just circle back one last time to the most fundamental principle here. If you remember nothing else from this entire review, please remember this. The contract is between the insurer and the employer. The employer is the policy owner. The employee is just a certificate holder.
So, to wrap this all up, let's test your knowledge. Ask yourself this question right now. Why is group insurance cheaper? And why doesn't it require a health check? If you can confidently answer that it's because the risk is spread across a large group of people and the administrative costs are way lower, then you've really got it. You have totally grasped the core concepts. You are ready for this section. Good luck on your exam.